Inflation is when prices rise over time, making everyday life more expensive for everyone. In simple terms, it means the value of money slowly decreases, so you need more money to buy the same things you used to buy before. This is not just a short-term change, it is a long-term economic pattern that affects nearly every household in the economy. Inflation is often described as a silent force because it does not happen suddenly, but gradually reduces purchasing power without most people noticing immediately. For most people, this means their money buys less food, fuel, and essentials. Even if their income stays the same, their daily life feels more expensive because prices keep moving upward. Families often notice that their monthly budget becomes tighter, forcing them to make difficult choices about what to buy and what to avoid. Over time, this creates financial pressure, especially for people living on fixed salaries or limited income sources. Even basic goods like groceries and transport become more expensive. A simple basket of household items costs more each year, and transportation expenses like bus fares, fuel prices, and ride costs also increase. These changes might seem small on a daily basis, but when combined over weeks and months, they significantly impact overall spending. This is why people often feel like their money disappears faster, even when they are not spending differently. When inflation rises, the value of cash in your wallet goes down. This means that the same amount of money can buy fewer items than before. Cash that once felt sufficient for daily needs slowly loses its strength as prices increase around it. This creates a situation where holding money without investing or growing it leads to hidden losses in value over time. This hurts people who save money in cash or low-interest accounts the most. If the interest earned on savings is lower than the inflation rate, then the real value of those savings decreases. Although the number in the bank account may look the same or even slightly higher, its actual purchasing power becomes weaker. This is why saving money alone is not always enough to build long-term financial security during inflationary periods. But wealthy people think differently during inflation. Instead of keeping their wealth idle, they focus on strategies that help their money grow or at least maintain its value. They understand that inflation is not just a challenge but also an opportunity for those who know how to respond strategically. Their approach is usually focused on assets rather than holding cash. They don't keep most of their money in cash. Holding large amounts of cash during inflation is considered inefficient because it continuously loses value in real terms. Instead, they keep only enough liquidity for daily needs and emergencies, while the rest is moved into investments or income-generating assets that can outperform inflation. Instead, they convert money into assets that grow in value. These assets are chosen based on their ability to increase in price or generate returns over time. The goal is not just to store wealth but to expand it even while the cost of living rises. This strategy helps protect financial power against inflation's long-term effects. One of the biggest choices is investing in stocks. Investing in stocks allows individuals to own a share of companies that can grow and increase profits over time. As companies expand and adjust prices in response to inflation, their revenues and market value can also rise. This makes stocks one of the most common tools for long-term wealth growth. Real estate is another major asset that often rises during inflation. Property values tend to increase because construction costs, land prices, and rental demand usually go up with inflation. Many investors see real estate as a way to protect wealth while also earning rental income. Over time, this combination can significantly increase overall returns. Businesses also benefit as they adjust prices to match rising costs. When inflation occurs, companies often increase the prices of their products and services to maintain profit margins. While expenses rise, pricing power allows many businesses to stay stable or even improve their earnings. This ability to adjust is one reason some companies perform well during inflationary periods. When companies raise prices, their revenues can increase too. If costs are managed properly, higher prices can lead to higher total income. This can improve company valuations and attract more investors. People who own shares in these companies indirectly benefit from this revenue growth, even when inflation is affecting everyday consumers. This often allows wealthy investors to grow their wealth even during inflation. While cash holders experience a decline in purchasing power, asset owners may see their investments increase in value. This creates a growing gap between those who rely only on savings and those who actively invest in income-generating or appreciating assets. So while one group loses purchasing power, another gains assets. Inflation does not affect everyone equally, its impact depends heavily on financial behavior and asset ownership. Those who understand how to position their money are often better protected, while others may struggle to keep up with rising costs. Most people believe inflation affects everyone in the same way. But the reality is very different. Inflation creates both winners and losers, and the people who truly understand the financial system are usually the ones who come out ahead. While millions struggle with rising costs, others quietly position themselves to benefit from the changing value of money. Understanding inflation is not just about economics, it's about understanding how wealth moves through society. For middle-class families, inflation often feels like an invisible tax that never stops increasing. Every trip to the grocery store becomes more expensive. Fuel prices rise. Electricity bills grow larger. Everyday essentials slowly consume a bigger percentage of monthly income. Even when life appears normal on the surface, inflation steadily reduces financial comfort behind the scenes. People begin working harder just to maintain the same lifestyle they had years earlier. One of the biggest problems during inflation is that salaries rarely rise fast enough to keep up with increasing prices. Businesses may raise wages slowly, but inflation can move much faster. As a result, the real purchasing power of workers declines over time. A paycheck may look bigger in numbers, but in reality, it often buys less food, less housing, and fewer opportunities than before. This silent decline affects millions of households every year. While workers struggle with rising expenses, real estate owners often experience a completely different reality. Inflation usually pushes rents higher because the overall cost of living increases. Landlords can often charge more for housing as demand continues rising. At the same time, the value of properties themselves may also increase. This creates a powerful financial advantage for people who already own valuable real estate during inflationary periods. The contrast between renters and property owners becomes especially clear during high inflation. Renters face growing monthly payments that reduce their ability to save money. But owners may benefit in two different ways at the same time. First, rental income increases. Second, the property itself may appreciate in value. This means inflation can widen the financial gap between people who own assets and people who depend entirely on wages. Wealthy individuals also tend to understand something many people fear: debt can become a strategic financial tool during inflation. Most people are taught to avoid debt whenever possible. But sophisticated investors often use debt carefully to expand their wealth. Instead of seeing borrowing as dangerous, they recognize that inflation changes the true value of money over time, creating opportunities for those who understand the system. During inflation, money slowly loses purchasing power. $1 today may buy less in the future. But fixed debt usually remains the same in numerical terms. This creates an unusual advantage for borrowers. If someone borrowed money years earlier, they may repay that debt later using money that is worth less than when they originally received the loan. In simple terms, inflation can reduce the real burden of debt over time. Many wealthy investors use borrowed money to purchase appreciating assets such as real estate, businesses, or investments. As inflation pushes asset prices higher, the value of what they own often grows faster than the cost of their debt. This creates leverage, one of the most powerful wealth-building tools in finance. While inflation hurts savers holding cash, it can significantly reward investors who control appreciating assets. Meanwhile, people who keep most of their savings in traditional bank accounts often experience a silent financial loss. Even though the number in the account may remain stable, the purchasing power behind that money slowly disappears. Inflation quietly erodes the value of cash every single year. If savings grow slower than inflation itself, people effectively become poorer over time without immediately realizing it. This is why inflation is often described as a hidden transfer of wealth. Money gradually moves away from savers and toward asset owners. Those who own valuable assets such as real estate, stocks, or businesses usually see prices rise alongside inflation. Meanwhile, people holding large amounts of idle cash watch the real value of their savings decline. The difference between these two financial positions can become enormous over long periods of time. One major cause of inflation is the expansion of the money supply. When central banks create more currency and inject it into the economy, more money begins competing for the same amount of goods, services, and assets. Over time, this can reduce the purchasing power of each unit of currency. Although money creation can stimulate economies temporarily, it can also contribute to rising prices across nearly every sector. After large amounts of new money enter the financial system, asset prices often rise dramatically. Stock markets may surge. Real estate prices can explode upward. Investment assets frequently increase much faster than wages. This is one reason why wealthy individuals who already own assets often become even wealthier during inflationary cycles. They are positioned where new money tends to flow first, while ordinary workers face rising costs later. This is why financial education matters so much. Understanding inflation changes the way people think about saving, investing, and building long-term wealth. People who only rely on income from work may struggle to keep up with rising prices. But people who understand assets, investing, and the movement of money can make decisions that protect their future purchasing power. Knowledge becomes one of the most valuable financial advantages. Many successful investors focus heavily on owning productive assets instead of holding large amounts of unused cash. Throughout history, assets like businesses, real estate, and stocks have often provided stronger protection against inflation. These assets may continue generating income while also increasing in value over time. Rather than allowing money to sit idle and lose value, investors attempt to place capital where it can grow faster than inflation itself. The goal is not simply to work harder for more money. Hard work alone does not always overcome inflation. The real advantage comes from understanding how money moves through the financial system and positioning yourself where inflation works in your favor instead of against you. People who understand investing, ownership, and financial leverage often benefit from economic shifts that negatively impact others. Billionaires prepare for inflation long before the public notices it. While most people are busy surviving day to day, the wealthy are quietly repositioning their money. They understand that inflation doesn't arrive overnight, it builds slowly beneath the surface. By the time the headlines start warning about rising prices, the smartest investors have already moved their capital into assets designed to survive and grow during economic uncertainty. The rich don't react late. They prepare early, because they know timing creates opportunity. Inflation is often called the silent tax because it quietly destroys purchasing power year after year. The money sitting in a savings account may look safe, but its value shrinks as the cost of living rises. $100 today will not buy the same things 10 years from now. Billionaires understand a lesson most people are never taught: holding too much cash during inflation is dangerous. Currency weakens over time, but ownership becomes stronger. The wealthy focus less on saving money and more on owning things that increase in value while prices rise around them. So what do billionaires actually buy before inflation hits hard? They buy real estate that can generate rental income. They buy stocks in strong companies that can raise prices and maintain profits. They buy businesses, energy, farmland, precious metals, and commodities that historically perform well during inflationary periods. These assets don't just sit still, they produce cash flow and appreciate as the economy changes. The wealthy don't rely on money alone. They rely on ownership, because ownership gives them leverage when inflation reshapes the market. Every major inflation cycle creates the same outcome: a massive transfer of wealth. People who depend only on wages struggle to keep up as living expenses rise faster than income. Meanwhile, people who own appreciating assets often become even richer. The financial system rewards ownership far more than labor. That's why two people can work equally hard, yet end up in completely different financial positions. One trades time for money, while the other owns assets that continue growing whether they work or not. Inflation widens that gap faster than most people realize. Billionaires also understand the importance of acting before the crowd. They do not wait for fear to dominate the news cycle or for experts on television to confirm a crisis. By the time the public starts reacting emotionally, smart money has already taken position months or even years earlier. Wealthy investors study economic cycles, interest rates, government policies, and market behavior long before inflation becomes obvious to everyone else. Their mindset is different, they think long-term, stay patient, and position themselves ahead of change instead of chasing stability after it disappears. Understanding inflation could completely change the direction of your financial future. The difference between staying stuck financially and building long-term wealth often comes down to one decision, whether you choose to remain a consumer or become an owner. Inflation punishes people who wait and rewards people who prepare. The question is simple: will you wait until rising prices force you to react, or will you start learning how the wealthy protect and grow their money before the next economic shift arrives?